now tuned into the Money Level Show.
Hello, everyone. Welcome back to the show. I'm here again with Steve, the Unemployed Value Degen. When are you changing this name? Are you going to change this name at some point?
No, I mean, I had worked a lot of jobs in my life. I was a roofer. I worked in a meat packing plant. I was a line cook, and I had never in 25 years of working, I'd never been fired, because I was always pretty nose to the grindstone. And so it really surprised the heck out of me when, the university got a new DEI president, and then suddenly my contract wasn't renewed. So I just in the moment, I called myself Unemployed Value Degen because it was really shocking. You work hard your whole life, and it just anyway surprised the heck out of me. But yeah, my Substack's going well. It's paying my half of the mortgage, so my wife can't complain. But I'll keep the name. I'm fond of it now.
Yeah, yes, it's growing on you. It's growing on everybody, right? So how many subscribers are you at now?
Oh, I think well, there's the free subscribers and the paid subscribers, but I think I've got about 6,200 in total. And yeah, Substack gave me my gold star. I have over 1,000 people paying to read my newsletter, which is pretty humbling.
Yeah, that's good. I mean, you've been coming on the show since I think you were at 2,000, a little less than 2,000 or whatnot. So I'm glad to see that growing.
Yeah, it's fun to watch things grow, and there's always a few unhappy customers, but most of my subscribers really like the content. The biggest complaint is that I write too much and they can't read it all. It's every day is too much. Although I did hit a little bit of writer's block. One of the sectors that's really beaten up is healthcare, and it's so far outside of my competence. I'll research a company, I'll get to the end of it and say, no, I can't publish this. It's not good enough. So I've had a slow couple of days here, but just the healthcare sector is so beaten down, and it really looks like it's still down 50% from the 2021 highs for small cap healthcare stocks. So there's got to be some treasure in there that's about to go rip some people's faces off.
Yeah. You just put out an article just highlighting some of the ones that you've chosen over the past year or two. And so if you all aren't subscribed, this is only $5 a month. Well, I don't know if you increase your prices, but
yeah, I'm up to $7 now, $7 a month.
I think I'm grandfathered in or something.
Yeah.
But $7 a month, you all just go hit the subscribe button, support my man's as he continues to put out content. I mean, because yeah, obviously, I mean, some people are going to be mad if they don't, if they lose their ass on something, but I mean, that's the point of diversifying. You have so many companies out there, and you're not going to hit that dartboard bullseye every time, right? But there has been some companies where it's like, damn, I wish I had picked that one, because so yeah, it's sure happens.
Well, we're all celebrating a little bit right now because of Babcock and Wilcox. It's this 170-year-old boiler company. So they're kind of the market leader in patents for boiler technology. And my thesis was that, for this data center build out in the short term, maybe 10 years from now, it's all going to be on nuclear, but in the short term, they need all the power they can get. And so for electricity plants, coal plants still run on steam boilers. You burn the coal to boil water to spin a turbine. The nuclear plants work the same way, but Babcock and Wilcox spun off their nuclear arm. That company is now BWXT, and BWXT is competing with Centrus Energy for, they're trying to get now into enrichment, but they're the nuclear boiler maker. But Babcock and Wilcox had really fallen on hard times with the U.S., shuttering coal plants. And my thesis was that in the next 5 years, every coal restart and every coal to natural gas conversion, they have a really good shot at being the engineering firm to handle that. And they did. They got a contract for coal to natural gas conversion. It increased their backlog by something like $274 million. And then, so that was my thesis, is coal restarts and coal conversions. And then out of the blue, it totally surprised me. Maybe it shouldn't have surprised me, but out of the blue, they got a contract to build a complex of 4 brand new natural gas boiler electric plants. And that was not on my radar because, natural gas those electric plants, the efficient ones, they use turbines from GE Vernova or from Mitsubishi. It's like a jet engine, but vertical, and they spin and they anyway, that's how the most efficient natural gas plants are run. But GE Vernova said if you want one, it's a 5-year wait. And I guess when these power plants or these data centers were looking around saying, how do we power this stuff? They say, well, we could do a coal restart, we could do a coal conversion, but then your location's kind of where that old plant used to be. And also the coal restarts, some of these coal shutterings, they were done in places where they still needed the electricity, but the governance of the state it was a blue state, and they said, we just hate coal and we're going to shut it anyway. There was one case where it was a power company that crossed the boundary from Minnesota to South Dakota. And in Minnesota, they shuttered the coal plants. The people in South Dakota were like, yo, dude, what the heck? That was our electricity. What are you doing to us? Like it's not like we had a surplus of electricity from all the other stuff they were building. They were just shutting it off anyway. And if the government of the state's against it, it's not going to get restarted. So out of the blue, these people building data centers said, hey, let's just build, instead of waiting 5 years for GE Vernova, let's just build natural gas boiler electric plants. And Babcock and Wilcox got a $1.5 billion contract to build this complex of 4 natural gas boiler electric plants. Their backlog went from 500 million to 2 billion in a blink of an eye. And the stock rallied from, $3 to $7 in real short order off of that. So, and now nobody knows, like for the next 5 years, are they going to do this 10 more times? Is how many boiler natural gas electric plants is the United States going to build while everybody's waiting for nuclear to roll out? I just still can't believe it's like the year is 2025 and this 170-year-old boiler maker company gets a new shot at life to build boiler electric plants to fund artificial intelligence. It's so crazy, but and I can't claim I was smart enough to see it coming because I was really focusing on coal restarts and coal conversions. I had nowhere in my write-up will you see me predict that, in the year 2025 of our Lord, that they're going to build boiler electric plants for natural gas. It's just crazy stuff.
Yeah. I'm actually just pulling up the chart now because you mentioned that it went to $7. I'm Yep, I see it. Because I remember it was trading at between 250 and 350, and then just here in October, in the last couple of weeks, it just shot up.
Well, I wrote about it when it was closer to $1, and so it's a 7-bagger for some of my subscribers. If you had extra cash in April, and I did not because I use a little bit of leverage, so I was totally squeezed in April. It was trading at I think about 22 cents a share in April. So, and I'm not claiming I was smart enough to do this because I wasn't. I didn't have the extra cash, but you could have gone from 22 cents to $7 in the course of, what is that, 6 months. So that's a pretty wild, explosive possibility for a 170-year-old boiler company.
Yeah, agreed. Especially, I gotta start putting just everything that you write about, just put it on the watch list, like because some of them I've made a decent amount of money on and everything. And so hoping we could talk about some more multi-baggers today. So Babcock and Wilcox. So we're also going to talk about SOLS. So let's transition to SOLS since that's in the same vicinity. And so you did a write-up on this here recently. It was a spin-off of Honeywell, right?
Yeah. So this was on my radar last year when everybody knew nuclear was coming back, right? The Overton window had shifted, the dam had broken. Japan was restarting nuclear. It was no longer a dirty word. Finally, these ESG crazies, these environmentalists realized, like, wait a minute, nuclear is zero carbon. And it was always sort of a mystery to a lot of people.
It's like, come on, y'all.
Yeah. So it was always so much of a mystery why environmentalists were so anti-nuclear. And I mean, it wasn't a mystery to me. Their fundamental philosophy is anti-human. Like it's Mother Nature is a goddess, and what comes from Mother Nature, that's beautiful. Like the wind, the rain, the sun is beautiful. But the artificial, the artifice, what man does with his hands, that's dirty because human beings are filthy, evil things. That's at the core of these extreme environmentalists and their philosophy. So nuclear was bad, even though it was zero carbon. And just the efficiency of nuclear fuel. Like if you're against nuclear, you just don't understand it. It's just outrageous how much electricity you can generate from a teaspoonful of uranium. It's just, but the window shifted. There was a news article I read that the law firms that were constantly suing people to try and get nuclear construction shut down, there was somebody interviewing one of them, and they said, yeah, our donors all dried up. Nobody's paying us to fund these lawsuits to shut down nuclear anymore. Just the window shifted. Silicon Valley, with all their money, they needed cheap electricity to build their new Tower of Babel, right? They're trying to replace God, trying to build a tower to the sky with artificial intelligence, and they need all the electricity they can get. And now, so middle of last year, it was clear this was happening, right? Nuclear was shifting. So I did a deep dive, and you've got several steps along the way, right? There's the miners who mine uranium, and I don't really like that because uranium can be mined in situ, right? You can pump liquids in the ground and slurp it out, and just like lithium. And whenever you can do that, the new capacity can be brought online faster. By faster, I mean like 2 years instead of 5 or 10 years. For a copper mine, you've got to get the permitting, you have to remove the overburden, you've got to build out this enormous complex. Like even if you were in a hurry and you had all the funding, it might not even be possible to do it within 5 years. But if you had the permitting and the funding and the expertise and the skilled labor, you could probably bring a uranium mine online, relatively quickly. I'm not predicting it will happen because permitting is still tough because local governments are afraid of nuclear and radiation. It's just sort of a phobia. But I don't like stuff that could be mined in situ. It's just they have the capacity to crush the price too much. The next step after mining, you got to bring it to the mill, but the mill is not so much of a bottleneck. The next step is called conversion. They have to take this uranium and they have to convert it to uranium hexafluoride. And after it's been converted to uranium hexafluoride, then they can enrich it. And then you get the enriched uranium. So at the time I wrote about it, it is a deep dive into uranium, and there was no way to own publicly a uranium conversion company. There was a really good choice for uranium enrichment, and that was Centrus Energy. I wrote about it when it was $40 a share. I wasn't smart enough to hold on to it. It was like 400. I think I sold it closer to 130. But I wrote about Centrus Energy when it was $40 a share. But there was one privately owned uranium conversion facility in the United States. It's called Converdyne. And when I wrote about it, it was shut down. It was mothballed. It's permitted. It's built out, but it's shut down. And since that time, since I wrote about it, it's been restarted. It's no longer mothballed. It is working. But it was owned by Honeywell. And Honeywell is just so big of a company that it made just a tiny, tiny blip on their radar, right? There's no point in owning Honeywell for this ownership stake in Converdyne. But Honeywell's following in GE footsteps, splitting themselves up into 3 parts. And the smallest part is called Solstice Advanced Materials. And the spinoff already happened. And for Solstice Advanced Materials, the uranium conversion is a full 12% of their revenue. So it's enough to move the needle. It's not like Honeywell, the large company, where uranium conversion was like less than 1% of their revenue. It's a solid chunk, and it has the capacity to grow. So now you could own a small cap that has the only private uranium conversion facility in the US. So that's another potential bottleneck. I don't think mining is going to be the big bottleneck. I think it's more likely conversion and enrichment are the bigger bottlenecks, long run. So this is a company you can buy now with exposure to that. Now, but it comes with all the other advanced materials stuff. Solstice has a lot going on, but some of the stuff they have going on is also really interesting. So they've got a chunk of their revenue from chemicals that are used in semiconductor manufacturing. So they make some of the chemicals that etch semiconductors. So that's going to be a huge growth market as we need all these GPUs for Silicon Valley to build the new Tower of Babel. And they also have chemicals that, did you ever build your own PC when you were a teenager back in the day when it was like a 286, a 386?
Nah, my nephew, he used to build them and everything. I'll watch him, but nah, I never did it.
Well, I remember we would have to put some kind of a gel on the CPU when we put on the heat sink to make the heat pass through it faster. So they make these heat transferring gels to get the heat off of the CPUs or the GPUs into the heat sink and get the heat taken away. So that's going to be a pretty big growth industry with all this data center build out. So Solstice Advanced Materials, they've got Converdyne, they've got the uranium conversion facility. They've got stuff for the data center build out with these, etching semiconductors and heat transferring off of GPUs. And they also have refrigerants. And refrigerants are another thing that is, one, it's just got its own secular tailwind because you remember that whole thing worried about the ozone layer?
Mm-hmm.
So these refrigerants, these are these compounds that they go up into the upper atmosphere and they break apart the ozone molecule. So there's all these regulations in the US and Europe to use more high-tech refrigerants. And so a chunk of Solstice Advanced Materials business is these sort of higher tech, more environmentally friendly refrigerant gases that are going to be, by law required in escalating fashion, both in the US and the EU over time. So anyway, it has a lot of interesting parts. Solstice Advanced Materials, it's a little bigger than the usual market cap I go fishing in. I mean, personally, I really wish they would just spin off Converdyne and it would be a publicly traded entity by itself and we could own a pure nuclear conversion company because it's only about 12% of their revenue. But, there's room for Converdyne's revenue to double within the next, who knows how many years because you're going to need so much more nuclear fuel for all the power plants people want to build. And they haven't even really been announced yet because this process takes time. But I don't think with all this data center build out, I don't think Silicon Valley is going to be content buying natural gas forever. They're not going to be content buying coal really that much at all. So I think that they have a lot of segments that have a long runway of growth ahead of them.
Yeah. Yeah, and then you also got to like factor in the risk of like the pendulum swinging back the other way, in 3 years or whatnot. Um, and then the whole ESG thing could come roaring back, right? And then so it's like, okay, well, if they don't want like coal and natural gas in that point, hopefully at this point they could logically see like uranium and nuclear energy is the kind of the middle ground here, and okay, this is what we need to do. But who knows,
Yeah.
right?
There's going to be some sentiment shifts. I mean, nuclear build-outs, a longer than a 10-year process. And at some point along the way, the investor is going to get bored with it. It's going to overshoot. It's going to pull back. And I don't know what the narrative shift is going to be, but the same thing just happened with rare earths recently. Everybody got all gung ho on rare earths, and then the stock stopped going up, and then they started going down, and then everybody's down on rare earths for a bit. But you've got this thing that's going to take years and years and years to finish, and in the meantime, there's going to be huge swings in sentiment driven off of just it overshoots, it pulls back, and then sometimes price drives the narrative, and when the prices go down, people are like, oh, rare earths are stupid, nuclear is stupid. So, over the next 10 years, there's going to be ups and downs, and I don't know what's going to drive the narrative shift, except, it'll get too expensive, it'll pull back, and people won't like it for a bit. But I think, the fundamentals are going to be just you're going to get improvement in the fundamentals with more countries increasing the nuclear build out. It's this demand for electricity is, I mean, the only real threat would be if the demand for electricity fell off. And there are some people who talk about that as a potential risk. Like, there's a chance that as AI gets better at programming, that they can write programming that's more efficient and uses less electricity. So that would be, I don't think that's the likely outcome because they always just want to keep on doing more and more compute. But you do have a possibility that the programs start getting written to be so much more efficient that they use less electricity. I would put that as kind of like a small black swan sort of tail risk. I think for right now, it's just more power, more power, more power.
Mm-hmm. Yeah, for sure. And then we still have population growth, even though like the birth rates, in many nations have declined. I think even the birth rate here in the United States, I was reading a article yesterday about the 50-year mortgage, and folks were, in this journalist was speaking about the 50-year mortgage, but saying like how folks couldn't afford homes, like younger generations, like the marriage rate since the 90s has dropped, the birth rate has dropped since the 90s. And so, and then also you have other nations, I believe China and such that, so I don't know how much that will impact it, but we have seen a huge population growth, over the last, however many decades.
Yeah, I mean, the United States' population growth is a little bit funny because it's driven by immigration and the children of immigrants, and a lot of how many kids you have just has to do with your perspective on hope for the future. So immigrant communities come in and they're like, well, life is good and the future is good, and that makes them want to have more kids. The same thing is true in developed economies. So my wife, she's an economist. She has a lot of papers on this. There was a baby boom in Spain when Franco, I can't remember how he left power, if he passed away or if they killed him, whatever happened. But when Francisco Franco's rule ended in Spain, there was a baby boom. And what was driven by, like, well, life is going to be better. Let's bring some kids into the world. So now, unfortunately, most of the governments in the West keep on pushing towards more authoritarianism, more control, more nanny state. It's people talk about what zoos used to look like 60 years ago, all these lions pacing around in little tiny boxes and how sad they were. And they don't put two and two together that, people need a certain amount of freedom to flourish and to thrive and to want to bring kids into the world. So you can have a situation in the West where if you have some, like what's happening in South America right now, I have to imagine that, if Milei gets all of his reforms through now that he has 20 senators, even though South America, and I was surprised, I always thought South America had high birth rates, but even in Brazil, birth rates are below replacement levels right now. But if you have huge pushes towards economic growth and freedom, and people suddenly feel like the world's becoming a better place and we can bring children into it, I don't think it's just this. The other thesis is that, okay, once you get education above a certain level, women just don't want kids anymore. And I think that's kind of disproven by the baby boom that happened when the Franco rule ended in Spain. If people believe life is going to be good, they want to bring kids into it.
Yeah, yeah, for sure. I mean, speaking of Malay in the recent election, I was a happy man when when those stocks started running back up. I mean, especially Cressy had went down
Yeah.
to what, $8, some $9, and then it popped. I actually bought some of the bigger caps, some of the banks and financials on that sell off, and then I was a happy man when that election had taken place. And so um, I want to transition to ABL. And
Yeah.
so let's talk ABL. Obviously, they've beat crushed earnings 2 quarters in a row. And so you've been writing about this along with companies like Jackson Financial and such, and these are kind of these, annuities, life insurance kind of spaces and whatnot. And ABL has been killing it. And then even when you look at like the analyst ratings, many analysts are rating it a buy. And so I want to get your perspective there on their recent performance. And you actually had a talk with the CEO.
Yeah, two times now I spoke with the CEO. And so Abacus Life is the company that I'm pounding the table on the hardest right now. And it's going through this transformative phase. It's so just background for the people that have hearing about it for the first time. I have 3 stocks that I've written about that are about how to navigate the baby boomers in their last couple decades of life. What are they going to do with their $75 trillion of assets? And so I have Finance of America Companies is the market leader in reverse mortgages. Jackson Financial is the market leader in variable annuities. And Abacus Global Management, they changed their name from Abacus Life. It's the market leader in life settlements, which is it's a very niche product. It's kind of unknown, although they are doing an advertising blitz. But if you have a whole life insurance policy, not term life, but whole life, in the United States, there was a Supreme Court case in 1911 that established that is an asset and you can sell it on a secondary marketplace. Now, most people don't know this. Most people, once they bought life insurance in case they passed away, would their wife be able to pay off the mortgage and would their kids be able to go to college? But most people don't pass away. Most people make it to the retirement and they get to be 65 and they say, okay, well, my kids have graduated college and the house is paid off. What do I need life insurance for? Why do I need to pay this bill that's like $200-300 a month forever just so my estate can have $1 million when baby boomers, half of them don't believe in inheritance anyway. So why should they pay $300 a month for the next 20 years just so their estate could have $1 million? If you're getting close to the finish line, if you're maybe within 15 years of your lifespan, Abacus Life will buy that life insurance policy. And they pay about 7 times what the life insurance company would give you in surrender value. So most people don't even know the life insurance company will buy you out. Most people don't know it has a residual value at all. Life insurance policy is a $20 trillion asset class. About 10 trillion is whole life policies. And last year, in face value, $450 billion of life insurance policies lapsed. And about 150 billion of those, the people were old enough that it had a redemption value. They could have gotten cash out of it. They could have surrendered it to the life insurance company, or they could have sold it to Abacus Life or one of their competitors. And out of that 150 billion of policies in face value that lapsed, only about 3% of that was sold on the secondary market. So this is huge, huge unknown, huge underserved market where people don't know, like you could have been leaving $200,000 on the table and you just let the policy lapse for the sake of, once you're on Social Security, you don't want to pay that extra $300 a month. And I get you, when you're on Social Security, you don't want to pay $300 a month. But there's a marketplace out there who will buy this stuff, and most people don't even know it exists. So it's still a story of penetrating this market and getting the word out there. But what makes Abacus Life so good is the transformation they're going through. They're not just going through the old business model of buying these life insurance policies and reselling them. They're trying to situate themselves as a major market maker. And I don't know if you're into Murray Stahl's Horizon Kinetics, he likes these marketplaces. He likes these, along with crypto and along with Texas Pacific Land, he likes these companies that are kind of market makers in these assets, these different exchanges. And Abacus Life is trying to transform itself into being sort of a market maker for life insurance policies. They've done a lot of transformative acquisitions. They bought a financial firm called Carlyle, not the big Carlyle, but a smaller company also named Carlyle, so they could roll out a mutual fund so that retail investors could invest in these life insurance policies. And so this gated mutual fund that they've created, last quarter got another $100 million of inflows into it. And it's these life insurance policies, you get a very low teens interest rate yields, maybe 11-12%, but it's uncorrelated with the market returns because it's only it's a liability of these life insurance companies and people's lifespan. So who doesn't want an 11 to 12% uncorrelated yield in a mutual fund? That's amazing. That's fantastic. So that's kind of outside their traditional business model. And they're doing a bunch of other stuff too, that they're expanding their capabilities to kind of create a whole ecosystem. And for the last 2 quarters, every single acquisition they made is growing independently of the primary business. So all these ancillary services, they're all coming online. It's kind of similar to like Rocket Companies is doing the same thing. They're going after all these ancillary services. It's not just they want to originate the mortgage, they also want to service the mortgage. They buy Cooper. And they want to expand their funnel. So they buy Redfin so that when people are looking up housing information online, when they buy a house, maybe they get these free originations that way. So it's very similar. They're trying to become this nexus in the whole market and have all these ancillary services. And I mean, I could talk about Abacus Life for a long. I've got 5 write-ups now, 2 summaries of conversations with the CEO, and every single aspect of their business is just booming.
Yeah. And you say you're pounding the table the hardest on this one.
Yeah. And it's still not counting growth, just where they are today. I think it's getting close to about a $7 stock, but just where they are today without any growth, it should be something like a $10 to $12 stock. And then if you look at how fast they're growing, if they had year over year something like 90% revenue growth, 80% net income growth, they keep on raising net income guidance for the last 2 quarters. They're it's just a fantastic rate of growth. And a lot of the growth now is embedded in these ancillary services. So even if they didn't increase volumes of their primary business, which I think they still are going to grow, just all the ancillary services to catch up to this, they're going to be adding a lot of high value recurring income on top of their, somewhat volatile income. So that they're really doing a good job building out this whole ecosystem. And I think it's fantastic.
Yeah, what would you say their price to book is right now? What are you thinking there?
Oh, it depends on, so they've got something like $420 million on their balance sheet of these policies they've bought. And then that depends on what are they going to sell these things for. And last quarter, they had a 37% markup because interest rates are falling, and that makes the prices of stuff you hold on your book, fixed income, more valuable. And they also had held a lot of policies longer than a year. And so a life insurance policy for a 76-year-old is more valuable than a life insurance policy for a 75-year-old. Every year they hold this stuff, it gets more valuable. And they also they just did something pretty fantastic, which is they took a big bundle of these life insurance settlements and they securitized them. They made an asset-backed security. They got a ratings agency to rate it, and the ratings agency called it, better than investment grade. So this is, again, it's the payout to you if you buy these life settlements. That's a liability of a life insurance company. Life insurance companies, they're highly regulated. They have very stable credit worthiness, and they have reinsurance through Lloyd's of London or Berkshire Hathaway or something like that. So the liabilities of these things are very, very credit-worthy counterparties. And so this is an above investment grade asset-backed security that they sold to, they just sold it to pensions and commercial banks. So that markup could get a lot higher through this securitization process. Because it's supply and demand, you increase the number of people that are capable of buying these things and you get to drive up the price. So we'll see, they've got, again, $420 million of these life settlements on the balance sheet. But they originate more every quarter. So, and then the question is, how big is the market going to be? And they also get paid to service these things. So it's just like rocket companies when they originate a mortgage, but then they also get the servicing revenue for the life of the mortgage. So that recurring servicing income, it starts out small, but as the market grows, it adds up over time. So if you fast forward a few years from now, and they've got their recurring revenue growing from all the servicing, there's a lot of parallels between rocket companies and Abacus Global Management.
Got it. So I know you have like future kind of price targets, like especially like on Jackson Financial. So Abacus Life, what's your future price target on where could this be in the next few years?
So I love spreadsheets and I love math models, but sometimes you get a situation where it's garbage in, garbage out because their growth rate has been so rapid. They've been doubling volumes year over year. They're not going to be able to double volumes year over year forever, but the market is so underpenetrated, right? You've got, again, $150 billion of policies lapsing that people could have sold to them. And the whole industry, all their competitors only bought about $5 billion face value worth of policies. So the market penetration can increase. Their market share has been increasing. In the last 10 years, they went from like 15% market share to 30% market share. You can't really put a price target on something without being able to estimate the growth. And right now, the growth is so fast, which is a happy problem because it's not being priced as if the growth were fast. But the growth is so fast, it's like Sonic the Hedgehog, right? Faster than the naked eye. You can't really pin it down and put a price target. I wrote on Twitter the other day, I bet you that it'll be over $50 a share within 5 years. I think that's sort of a moderately conservative estimate.
Yeah, that's conservative. You all conservative. So be sure to go subscribe, check out Steve's work on this company. He's interviewed the CEO multiple times and he's written about it multiple times and he's pounding the table on it.
Yeah.
Also, be sure to go check that out. All right. So last company I want to cover is Cogent Communications. This was a stock that you wrote about recently, especially with the data center build out and such. This could be a beneficiary. And Cogent was paying what 10 close to 10% dividend. Recently sold off after earnings. They cut the dividend significantly. I think they cut it from $1 to like 2 cents or something like that. And so people were upset about that. But they did sell a couple data centers, and they're looking to get their leverage under control and such, which it's just a noble thing for a business. But and right now the stock, I think it's at $21, somewhere in that range.
Yeah.
And so just interested if you have any updates there.
So Cogent Communications is kind of a new one that I've been following. And sometimes I write about a stock, it hasn't completely bottomed out, it's still a falling knife. I had thought that Cogent the price had to be pretty close to the bottom, and I was wrong. But you need to kind of understand the background of the company a little bit. This is from .com era stuff, where the founder CEO of this company is an absolute genius. Like, the guy got his PhD when he was 17 years old. And then he's also a very prudent, very careful operator. So he left his PhD after he was 17 years old, took over his father's taxi business, and then grew it to take over half of the Washington, D.C. metro area. So he's just, a very bright guy who very prudently and carefully grows a business. And after the .com crash, he saw this massive overbuild of this laid fiber optic cable. And you could buy that. I mean, this company has done, I think, 7 acquisitions over the course of since its founding, and it's all been these laid fiber optic cable that he's getting for, I mean, not just pennies on the dollar, but through the first 20 years of the company's life, they did 6 acquisitions, and they were very cheap for what was put in the ground. But about 3 years ago, they did their biggest acquisition. They literally doubled the size of the business. And they bought this fiber optic cable network already laid in the ground from T-Mobile. They bought it for $1. And this fiber optic cable network cost over $20 billion to build. So you're buying
$1, you mean that literally?
Literally $1. For $1, they bought this $20 billion network of laid fiber optic cable for $1. Because, there's maintenance costs. You have to be able to operate something and run it efficiently so that it generates revenues to overcome the maintenance costs. And T-Mobile couldn't do it. But Cogent Communications has always been in their industry for laid fiber optic cable. They've always been the market efficiency leader. And so the founder of this company said, look, I can make this thing efficient. I can turn this thing profitable. You want to give me $20 billion of laid fiber optic cable for free? I can get it to be profitable. Now, it came with all these legacy money-losing contracts. So for the last 3 years, they've been waiting for these contracts to run out and firing customers. So they acquired this giant network of fiber optic cable, and it's immediately losing money. And so it looks terrible. If you look at the financials of this company, it looks terrible. Like, what the heck is going on? How are these people losing money? Well, they've got these contracts from legacy customers that they inherited with this network that they have to service. And then and you'll see, so revenue is falling. Investors hate it when revenue is falling. They're firing customers that are losing money, and that's a good thing. Now, I still have confidence that it's been 3 years, and they've been digesting this network, and they have to spend some CapEx to modernize it and to make it compatible with their existing network and double the size of the company. And if you look at EBITDA, it's been growing, right? So their earnings, their gross profit, their operating earnings have been growing, and there's still wood to chop. There's still efficiencies to gain. There's still some of these legacy contracts to fire. They have guided toward next quarter is the first quarter where they return to revenue growth, where they're running out of these legacy contracts to fire, and they'll be back on a growth trajectory. And something else happened that was kind of amazing, and I missed it the first time I wrote about the company. So these fiber optic cable networks, at the hubs, these companies have to operate their own data centers because you get this traffic coming in. Sometimes it has to be processed. They have their own data center needs. Before this T-Mobile acquisition, Cogent Communications had 53 data centers. Now, the T-Mobile acquisition, which they got for $1, came with 47 data centers. So now this company has 100 data centers sitting at all the hubs of their fiber optic cable. And as they rationalize this acquisition, as they take these 2 networks and make it into one network, they realize out of their 100 data centers, they only need 76 of them. So now Cogent Communications has 24 pre-existing, already built, finished construction data centers hooked up to the grid. It's not like the local utility can say, we don't want to sell you power. It's hooked up to the grid. They're already, so they have electricity. So they're on a communications network. They're hooked up to the grid. They can buy electricity, and they have 24 data centers that they can now sell. And in the AI revolution, data centers are literally the hottest commodity on the planet. So now Cogent Communications is going to the market and saying, hey, you know the thing everybody wants right now? You know, data centers? We got 24 of them for sale. And when they announced that, they've already gotten, I think, 6 letters of intent. And some of those letters of intent were for all 24 data centers. They've only announced the first sale of 2 of these data centers, and it was for $144 million. And they don't give granular data. You don't know if that's, you know, if those were the best or those were the worst or those were average. So you don't really have any way of gauging. You know, for one thing, I don't think there's any doubt that they're going to be able to sell these data centers. They're literally selling the hottest commodity on the planet right now, which is a completed data center that's on the grid, on fiber optic cable networks, just ready to go. I mean, some of the large hyperscalers, for their quest for, you know, this general intelligence, they want to build a brand new thing so that it can use, you know, the newest chips, the newest racks, the newest cooling. This is an older data center. It's not going to be, you know, the buyer is not going to be Mark Zuckerberg with Meta, right? It's not going to be OpenAI. They want to build a brand new campus that's the size of Manhattan. But there are a lot of AI uses. There are a lot of needs for data centers that there's going to be buyers for these things. I have no doubt they're going to be able to sell all 24. And then I don't know, is this going to raise $1 billion? Is it going to raise $1.5 billion? I think they could wipe out their entire debt stack in the next 6 months just from selling these surplus data centers that, again, they acquired for $1. And there was some CapEx to modernize them. There's some CapEx to rationalize them. But that all that CapEx to get them ready for sale, that finished in Q2. And now they're on the market. So just in summary, so you know, sometimes when you have some negative momentum, the momentum factor just keeps on pushing it down. And this stock price has really been pushed down pretty hard. But you have a situation where it's the most efficient operator in their space. They probably have a combined $40 billion of build cost. That, and if that was replacement costs, might be a good bit higher because this stuff was built years ago. But this network now is about $40 billion of laid fiber optic cable. If at any point in the AI revolution that data transmission becomes a bottleneck and that fiber optic cable network starts fetching rents that's commensurate to replacement costs, this thing is a moonshot. And there's already been some news articles that that's happening for undersea cables. So the cables that connect Europe to the US, those things are already hitting some transmission limits. But this laid fiber optic cable that we laid for the .com era when we overbuilt by so much, if that actually gets squeezed, then this company is going to have this, you know, they're going to have not just selling 24 data centers into the AI revolution, but then they'll have the next hottest commodity on the planet, which is the bottleneck for the AI build out. I don't know that that's going to happen. But if you look at Corning, so Corning, this, you know, ceramics company, they were the company that built the fiber optic cable for the .com revolution. Last year, there was a news article. I mean, they had so much fiber optic cable in warehouses they had built from, you know, people that made orders and that didn't pick it up because they went bankrupt. They only started making fiber optic cable again last year after 25 years. So, but the demand is there right now. Now they're making fiber optic cable again, and Corning became a data center beneficiary, for an AI beneficiary. So if at any time the laid fiber optic cable in the ground becomes a bottleneck, well, Cogent Communications, this tiny little company, has $40 billion worth of it. It's a huge network. And if it causes their rents to go up, if it causes, you know, the cost of data transmission to go up, this company is going to be a moonshot. And in the meantime, even if it doesn't, it's got an efficient operator. They're increasing efficiencies. I think with these sales of the data centers, I think they're going to completely wipe out all their debt. They suspended their dividend and the share buyback because they wanted the debt to get to below 4 times EBITDA. But if in the next 6 months they wipe out all their debt, then they're going to restart share buybacks and dividends again. But I think some companies, they get a shareholder base. And that shareholder base, I think in this case for Cogent Communications, they were dividend people. And when that dividend got cut, they dropped that like a bad attitude. I mean, they just kicked that company to the curb and the stock prices just crashed. So I think the founder is brilliant. I think it's a good company. I think it's a good strategy. I think he is going to get the efficiencies. And on top of it, he's selling 24 data centers. He's selling the hottest commodity on the planet into the market, into a mania. And I think he's going to totally wipe out the whole company's debt stack.
Yeah, yeah, for sure. Yeah, I'm just looking at the charts now, looking at the RSI. They had three, well, Liberation Day, then they had August, and then the recent sell-off, they had huge drops. I mean, it's back to 2012 lows and such. And so, and then the high for this company was, some a little over $90, $93, almost $100. So, there's so many different components to this AI data center build out. Like some folks just think like you're just gonna get that it just magically happens, and you have all these pieces to the puzzle that can benefit from all of this capital that's being deployed into AI and such. And so yeah, Cogent, it seems like something that, for me, I think, it's a falling knife. I lost a little bit of money, but I'm thinking I may throw some more money back into it, because
Yeah.
especially if they could wipe out their debt in 6 months. Um, the amount of data centers they have, I mean, they recently just sold two of them. They have letter intent for others and such. And so, yeah, I mean, they've obviously been a successful company in the past, and right now they're just trying to get this debt under control, so it could be a beneficiary in the future for sure.
Yeah. And the debt really wasn't the problem. The problem was that it was genuinely taking them longer to digest this acquisition than they had anticipated.
Yeah.
And, whenever a stock price goes down, people are like, oh, this management team, what a bunch of clowns. I hate their guts. And I'm so could you do a better job? Nassim Taleb talks about this sometimes where if you have a bunch of small things in parallel, it's a much less complicated thing than if you have one giant enormous thing. So for example, if they had done five $4 billion acquisitions, they might have been able to digest those within the time frame management had allocated for digesting them. But if you have one $20 billion acquisition, there's a whole layer of complexity and problems that gets added onto that. So am I going to fault management for, okay, digesting a $20 billion acquisition took longer than they thought it would? I mean, you can, but why are you going to knock on a company that's had such a good track record over time at being the low cost operator? I mean, these people are doing a really good job in their space. And sometimes management's predictions don't come to pass. When you're doing something that's never been done before, like when you're digesting a $20 billion laid fiber acquisition and rationalizing 100 data centers down to 76, like there's going to be surprises there. So it's easy to armchair quarterback, and it's not good when management misses their own guidance.
Yeah.
But digesting a $20 billion acquisition takes time. Sometimes you gotta give them time to cook. And I think that's what's going on here is like there was a level of complexity they didn't anticipate. It's taking longer to digest than they anticipated. But I don't think the story is over. I don't think it was, oh, they failed, they can't do it, it'll never be profitable again. I mean, just check out their EBITDA quarter over quarter, and the graph has been climbing out of the inefficiencies. So again, they have all these legacy Sprint contracts that are money losing, and they have to roll off. I think the duration of them was something like 54 months. I mean, that's 4.5 years of bad contracts to wear off, and they're most of the way through that now. So I think it would be premature to give up on them. It really shocked the market when they cut the dividend down to pretty much zero. And I think what happened is they had a shareholder base, and it takes a long time to totally swap out your shareholder base to go from a stodgy dividend paying company to an aggressive data center growth company. The story has to get out about you, and you have to get a whole new shareholder base. And so I think that's what the sell-off is. But the founder of the company still loves returning capital to shareholders. So as soon as they get past this hurdle, they'll probably reinstitute an enormous dividend and share buyback program again. They just need to get to the other side of this digestion.
Yeah, for sure. Yeah, appreciate that, Steve. Well, appreciate you coming back on the show and everything, giving the audience these updates on some of these amazing write-ups. Where can people connect with you? Obviously, you have the Substack, which we'll link to below, but then you're also active on X. And so where can
Yep.
people connect with you?
Yep. So I'm Unemployed Value Degen on Substack, and I think on Twitter it's Unemployed Small Cap Value Degen. That name's a little long and maybe a little cumbersome, but yeah, that's sort of the two best places to find me. But yeah, I'm out there every day turning over rocks, trying to find new amazing stuff with the multi-bagger potential. And sometimes I find them. I gotta pat myself on the back a little bit for Babcock and Wilcox because that one. And again, I was right for the wrong reasons. I didn't think that they'd be doing new build boiler electric plants in 2025. Like that is just a wild story. But the thesis, it was kind of right that this is a world where you need every megawatt you can possibly get. And GE Vernova says, wait 5 years, we're not going to expand capacity for you. So something was going to happen, whether it was coal restarts, coal conversions, or now new builds. Go figure.
Yeah, for sure. Well, you all be sure to go check out Steve on X as well as Substack. I will link to it in the description below, and hit the subscribe button if you haven't subscribed yet. Love to have your support. All right, Steve, until next time.
Thank you for having me, Daryl.